We live in a world defined by the speed of light, where data streams across oceans in milliseconds and supply chains coordinate in real time. Yet the underlying plumbing of the global economy still moves at the speed of a paper-based bureaucracy. This delay is known as T+1 settlement. When a multi-billion-dollar bond trade happens on Monday, the capital doesn't actually clear until Tuesday. For those 24 hours, trillions are trapped in a regulatory waiting room, unable to be reinvested or used as collateral. It is an artificial speed limit on the movement of money, an inefficiency that forces the global economy to wait on systems designed for the 19th century. Starting in 2026, Japan plans to eliminate that delay. They are taking their entire government bond market, currently managed through these physical certificates, and moving it onto a blockchain. This is a $9 trillion transition. The goal is T+0 settlement, which allows these massive pools of capital to clear and settle the exact moment a trade is executed. Japan is following a path recently blazed by the United States. Through the DTCC, the U.S. has already placed nearly $13 billion worth of treasury bonds on-chain, proving that institutional-scale tokenization can function in the most liquid market on Earth. We are watching a technological arms race, a competition between the world's leading economies to build a new operating system for global finance. The engineering behind this shift comes from the heart of the Japanese establishment. The consortium building the platform is led by the country's 3 megabanks, including Mitsubishi UFJ, alongside Nomura and Mizuho. They utilize the Canton Network, an institutional blockchain providing the privacy these banks require to share a real-time ledger securely. To settle trades instantly, they use yen-denominated stablecoins, allowing 24/7 transactions without waiting for the legacy banking day. This entire system is being built to operate within Japan's existing Book Entry Transfer Act, proving that this technology can scale without abandoning current legal frameworks. By integrating these digital currencies with massive institutional networks, tokenization has moved from the experimental phase into the core of the financial system. The clock is ticking. Formal trials wrap up in September 2026, with the full project aimed at a market-wide launch by the end of that year. Japan's tech-to-GDP ratio exceeds 200%, the highest among developed nations. Zero interest rates previously kept this manageable, but the landscape is shifting. The Bank of Japan is ending bond buying programs, and 10-year bond yields have climbed past the critical 2% mark. On a $9 trillion debt pile, even tiny moves in interest rates are devastating. If yields continue to rise, the interest payments alone could consume 25% of Japan's entire national budget. In this environment, tokenization is a firewall. It provides the liquidity and settlement speed required to keep the market moving even as borrowing costs climb. Once Japan proves that $9 trillion in sovereign debt can be settled the moment a trade is made, the multi-day delays accepted by the rest of the world will become an unacceptable cost of doing business. The pressure to adopt this standard will move through Europe next, targeting the massive bond markets in Germany, France, and the UK. There is an additional $16 trillion in global sovereign debt currently tied up in legacy repo markets that could be unlocked by this transition to instant settlement. This explains why BlackRock, with $10 trillion in assets, is a key participant in the Japanese consortium. They are positioning themselves to manage the foundational platform for this massive transition. The entities that successfully build this new financial plumbing will be the ones that export it to the rest of the developed world. This shift marks the moment blockchain stops being a tool for speculation and begins serving as the world's underlying financial infrastructure. The Canton Network and these tokenized bond markets are the successors to the SWIFT network and the legacy settlement systems of the Federal Reserve. In this new environment, the very concept of waiting for money to arrive will become a relic of a slower, less efficient era.